Good morning, everybody. Welcome back to my channel. It is me, the Millennial Investor 1914. Yes, it is me. I come here to deliver that fire content, but let's not delay today's topic. Today is going to be a heavy topic, and I've been reluctant to do this video because I already knew that for me to do this video, I was gonna have to set up certain tabs and break certain things down because this may not be as probably exciting of a topic as how to make $250 or how to make $800 per month type of video, right? Where someone's just trying to make money. This video is for individuals who are new investors or dividend growth investors, and they just need to learn the basics and the guidelines. I've made videos on how to create a dividend growth portfolio, how to analyze and come up with your own strategy. But in this video, it is what it is in regards to the name, and we're going to dive in because don't want to make this video too long and don't want to bore you. It's the 10 commandments of dividend investing. Yes, if you are a Christian or whatnot, and you know about the 10 commandments, you already know these are the things that you should live by. You got the stone tablets. These are the things you should live by and should always keep it in the back of your mind when you're investing and when you're buying. Let's dig in. We're not going to hold any further. Starting out with one, the commandment number one: Thou shalt not covet thy neighbor's yield. And basically, in understanding this, you have to understand that when you are watching YouTube videos and when you see like a video of mine, you see uh, like Graham and all these great YouTubers or Gen X investor and all of these individuals who are like our mentors, right? So you'll see their portfolios, and then typically what you will tend to do is that you may see that oh man, this person is making X amount of dollars per his portfolio is 500,000, $1,000,000, right? And you may see certain stocks that you may want to buy into, so you may try to copy it, or you may like, okay, these these yield max stocks, right? Like the Tesla yield max and all this and that. So you may invest in that or into JEPI or into QYLD to get the yield. And so you will copy these people's portfolios and kind of find out you may be 20, 25, 30 years old, and you probably don't need the income right now. And so you probably invest in those type of stocks. And guess what? You coveting thy neighbor's yield is, man, you trying to copy their person's portfolio and invest like them, and you need to come up with your own investing strategy. And depending on what your strategy or your goal, by copying them, you could seriously like ruin yourself, right? So instead of high yielding stocks like JEPI, QYLD, XYLD, some people will ignore investing into stocks like Coca-Cola, McDonald's, stuff like that, where it may have less sexy of yields, but it compounds along the way. And one of the rules of engagement a lot of new investors don't have is patience. Being patient and letting your money grow and let your money make money for yourself. And if you don't need the income right now, you don't need to be investing to yield maxes, ETFs, and 50% to 20% yields. Commandment number two: Thou shalt always reinvest your dividends. So the power of reinvesting your dividends can often be hard to articulate by words. And so I have a calculator. So I set it up for you. When you first start out as a dividend growth investor, I did it at $10,000 per year. But let's just say you're not making enough money initially. So you start out with $1. You start out with $1, and there you go. So you start out with $1, and you contributing $2,500 on a annualized basis. You divide it by a 12. It is what it is, right? And as you see, by reinvesting your money, it starts off small, right? It starts off small. Where let me pull this up. At the end of the day, 2,500, right? Yeah. So at the end of the day, year one, 2,500. then new balance after year 2, and it adds up, right? It just adds up. So you reinvest yourself. That's simple, right? After 5 years, you have a portfolio balance of 16,000. After 10 years, you have a portfolio balance of 45,000, right? And it starts out small, where at 10 years, your annual dividends only paying you $1,100 and $1,134, and you're like, oh, that's nothing, kiddo. That's not gonna pay my bills, right? Okay. After 15 years, just only $2,500 per year, right? This is not take consideration that the older you get, you make more money. You receive bonuses along the way, commissions, may have a second job, may have another business, right? This is just you just contributing $2,500 per year. Typically, the older people get, people make more money. People get insurance money, probably winning the lottery. So you probably have access to more money to invest, which means that this amount will increase. But we'll just stick with 2,500, right? Let's just say you stuck with it for 20 years, right? You stuck with it for 20 years. Now you have a portfolio of $192,000 and it's paying you $5,000. Let's just say that you stuck with it for 30 years. You working at a plant 30 years, and basically now you have a portfolio of $671,000, only just paying $2,500 per year. Divided by 12 is probably nothing, right? And then it's paying you $17,000 per year, and then it's paying you $17,000 per year, and this is not even add and include your Social Security, filing for Social Security, and then also what if you were contributing to your 401k along the way. This is just you adding $2,500 to a dividend growth portfolio and just growing it $2,500 per year. This is not including if you wanted to increase $2,500 to $5,000 per year, or adding $10,000 per year, $12,000 per year, right? Because then if you increase that amount, guess what? This amount going to be more, probably in the millions, and then this amount, imagine you just double it. Now you have a portfolio that's $1 million that's paying you roughly $40,000 per year. So you mean to tell me that by doing that, you can't live off of $40,000 to $50,000 per year passive income, your Social Security, and then also having a 401k with your job? So this is the power of compounding. So commandment number 2: always reinvest your dividends so it can compound. So that basically it starts out, you always reinvest your dividends, because yes, it starts out small. Your portfolio may look like the reinvesting your dividends is not doing anything, but those shares are buying small shares, which buy more shares. That over a period of time, 5 years, give it 6 or 7 years. I'm in that 7 to 8, the 7.5, 8 year mark. Now my dividends, give you an example. Now my dividends are compounding. So as you see right here, see right here, annual to $2,000. Again, it starts out small, right? But then the more you reinvest, guess what? This was originally probably me starting out was probably $10, and then by me buying more shares and reinvesting, that $10, probably went to $10 annual, right? Probably went to $20. Slowly probably went to $30. Then Abby increased his dividend. I also was reinvesting the dividend, and then those shares bought more shares, and then I bought more shares, probably one share here and there, because Abby was $100 some dollars, so that I probably bought a couple shares along the way, and then the reinvested stuff, and then guess what? Now it's at $114, and then guess what? In 5 years, this $114 may be $150, $175. Then another 5 years, it may be $200, $250, and then that's the power of compounding. Always stay compounding. Always reinvest your dividends. 3, honor thy tax implication. Tax bracket. The tax bracket, the normal tax bracket when you file your taxes, 10, 15, 25, 28, 33, 33%. With dividend growth stocks, either just stocks in general that you hold for the long haul, for long-term capital gains, or just dividend growth stocks, is taxed at 0%, 15%, and then individuals who make $400,000, then you finally get taxed 20%. But for the most part, you only will be taxed 15% max. And if you are married, you can make up to like $80,000 in dividend income and not be taxed. Be taxed at 0%. That's just the tax code for dividends. So that's why a lot of individuals like to invest in dividends, dividend growth stocks, and just long-term capital gains. Keep that in mind, long-term capital gains. Number 4, honor thy payout ratio. So wanted to go over. So you go to Seeking Alpha, you type in a stock in the search key, and then you see right here a couple key metrics that you just always get to keep in mind when you're buying certain stocks, and then certain stock that's in your arsenal in your portfolio. This pays out 7.73%, and your payout $1.11. Payout ratio 44%. Got to keep this in mind because a year or two ago, this payout ratio was upwards 80%, 90%. Keep in mind, regular stocks, that's alarming. Other stocks, maybe not so much. Again, let's try this example again. McDonald's, 2.69% dividend yield right now, has a annual payout of 6.68. Payout ratio 53%. So keep that in mind. It's creeping up, right? So it's 53%. It's cool. It's all right. It's not good. It's not bad. But keep in mind, like, okay, I'm buying McDonald's, so I got McDonald's shares in my portfolio. And so you got to keep in mind to make sure certain stocks are still profitable. Is it still making money? Is the free cash flow, is it increasing? Are people still buying their products? And that goes to anything. Is people are still consuming gas, ExxonMobil or Chevron or certain products, right? As consumers, if consumers are not consuming said product, if said company is not making money, Apple or Microsoft or whatnot, guess what? This payout ratio is going to increase because they're not making any money, and by you being an investor, it's going to put you at risk of, man, my hard-earned money is in the stock, in this company. We think stocks, but it's really, I'm investing in the future of this company, and if this company is not making money, then eventually down the line it's going to default, and it's going to put me at risk. So that's risk management. You have to think of it like that. And so this is how you do research to understand what is the payout ratio of the company. Commandment number 4. Commandment number 5, thou shalt understand foreign dividends. And so understand just foreign dividends. You just click on right here. I'm not going to go through that, but basically just understand the foreign dividends, depending on where they are at. Some are more favorable, some are highly less favorable in regards to how much they tax you. So it's really good to own foreign dividends. Enbridge, BTI. What else? What's another foreign dividend company? TD. Toronto, the Dominion. That's a bank, Canadian bank. CM, which is a Canadian bank, and other foreign companies and foreign stocks. Just understand that there are stock tax implications. So it may tax you 15%, may tax you 20%, may tax you 25% on your income, on the dividend that you receive. So you may be intended on maybe receiving $10, but they probably tax you 25-30%, and you might only receive $7, $6.50, right? So it sucks because you're expecting $10 per quarter, and you really only receiving $6.50, $7. That adds up over time. You may say, "Oh, Kadir, that's that. Right now, that's fine," and that's our thought too. But then over time, you want. If you're making $40, $50 per year on an annualized basis, I want my whole $40, $50. I don't want $35. Like, no, I want all my money because we work hard for it. Correct? Commandment number 6: thou shalt not bear false witness against high yields. And basically, with this, when you invest into high yields, always do your research what it is. So, example, in my portfolio, I have high yields. I'm not going to sit here and tell you do not invest into high yields. I invest into high yields. Right here, ARCC is 10% BDC. Blue Owl Capital BDC 9.78%. Mo, which is a tobacco company, not 9.919% right now. EPD, which is a it's not a BCE, it's a I forgot what is it called. When I think come to mind, you guys know what EPD is. I forgot what it is, man. It's not a regular company. It's not. I forgot what it's called, but it's at 7.24%, and then which is Realty Income, which is a REIT, 6.07%. Now, in my portfolio, I have a lot of low yielding stocks as well to balance and counter having a lot of high yields. I have Intuit, Costco, Eli Lilly, Visa, as you see right here. A lot of these stocks, Microsoft, Applied Materials, etc., are less than 1%. So I'm not going to sit here and tell you to not invest into high yields. Just understand, it's EPD is MLP, MLP, yes, yes, a limited partner company. But yes, just know that when you are looking at high yields, understand what type of company is it. Is it a MLP? Is it a BDC, business development company? Is it a REIT? Just understand it, because by you buying a REIT, you buying a BDC, you know that the common annual percent of said BDC is probably 8%, 9%, 10%. If it's 15%, then you would recognize and know that that's extremely risky. Or if you buying a REIT, you will know that, okay, REITs are typically 5%, 6%, sometimes 7%. You be okay. It's you look at the free cash flow and AFFO and adjusted free cash flow and all that, and you can see, okay, that's right around the average or the median or the average of said REIT or BDC. But it's usually when you see like 30%, 25%, even sometimes 15%. Put your antennas up, and then that's what you have to do your research on. Go on the company's website. Go on Motley Fool. Type in Motley Fool. Put the company and the ticker symbol in there. Go to Morningstar. Do research on Morningstar. You do extensive research on a company, because you're putting your hard-earned money on the table. And it's nothing wrong with having high yielding stocks in your portfolio, because in times like this, when it's down markets, when it's recession, you need to and want to make money, but you want to put your money into credible companies that has been around, that has been, if not increases dividend during recessions, at least maintain the dividends in a recession, and then also companies that are not losing money. So these are things you need to look at. So I'm not gonna bear false witness against high yields and say don't buy it, because I actually have high yields in my portfolio. It's all about balance. I'm not gonna say don't ever eat sugar, or don't ever eat candy or chocolate, but don't eat it for breakfast, or don't eat it all day every week. It's okay to have some, but not all, right? Commandment number 7: Thou shalt favor companies that raise their dividends consistently. And with number 7, all what they're saying is this: in the dividend community, as we know, we call these companies dividend aristocrats. So companies that have increased their dividends by 25 straight years, dividend aristocrats. And so typically a lot of people just go here and organize, and then companies like Centos, C.H. Robinson, PepsiCo, McDonald's. That's why you see I got McDonald's in my portfolio. I got Lynn in my portfolio. Some people got Caterpillar, W.W. Granger, Air Products and Chemicals, Illinois Tool Works, Chevron, ExxonMobil, etc., etc. And so thou shalt favor companies that raise their dividends consistently. And then also, if you want another group of ideas, right? You got the dividend aristocrats. You have the dividend kings who have increased their dividends for 50 plus years. And then you also have dividend achievers. Dividend achievers have increased their dividend for the last 10 plus years. So dividend aristocrats, 25 plus years, dividend achievers, 10 plus years. So as you know, right here, it gives you just a greater pool of stocks to do your research and to pick from, right? Commandment number 8. Commandment number 8 is thou shalt not make dividends thy only priority. Now, you say that, but we are dividend growth investors. And so only thing I'm going to say with this is that this ties in with the high yielding stocks, and this also would tie into my portfolio. And I like to use myself as an example because you lead by example. So, and I say that and me saying this. Usually, when people think of just dividend growth investors versus growth investors, people think that by being a dividend growth investor or a dividend investor, that you only invest into stocks that only pay a dividend. Well, all of my stocks pay a dividend, but all dividends are not created equal. All stocks are not created equal. Let me give you a quick example because I don't want to make the video go too long. Apple, my low and paid dividends. Apple, Eli Lilly, Applied Materials, Microsoft, MSCI, Lind, NOC. I just started a new position with Northrop Grumman. All of these companies right here, as you see, it's under 2%. It's under 2%. They pay a dividend, but it's under 2%. Now, compared to higher yielding stocks like ARCC, OBDC, Mo, Amgen, Home Depot, probably and then probably Pepsi, right? These companies are probably a little bit like slow growing. They're mature. They pay their dividend. It's stable, right? But stocks, my loyal stocks like Hershey, Applied Materials, tech company, Broadcom, tech company, Apple, tech company, Eli Lilly is a healthcare company, MSCI, finance, NOC, which is industrial, but also which is defense. So by investing in these companies right here, initially you'd be like, oh yeah, they pay a dividend. You're a dividend growth investor. There's no way that these stocks will beat the market. But when you go into detail, give you an example. When you go into detail, and I click Eli Lilly, and I click on summary, you will see that by the naked eye, that year to date, Eli Lilly year to date, just this year alone, is up 66%. 5 years, just 5 years, invest into the Eli Lilly. If you had invested in Eli Lilly for 5 years, it's up 450%, and then 10 years, it's up 1,129%. Do the rule of 72. Do that amount, divide by 72. That will give you the amount. If you would have invested 10 years ago, like $10,000, what your $10,000 will be worth right now if you just double. So I say that in saying that thou shalt not make dividends the only priority, which is true. Meaning that, yes, as a dividend growth investor and a dividend investors, our goal is to make money, but our also goal is total return. And this also, I'm going to incorporate 8 and 9 together. So thou shalt not make dividends thy only priority, and thou shalt not thou should be wary of value traps. So stocks that are value traps are like Verizon and AT&T, high yields, but if you look at the past 5 years, it hasn't made investors money. But when you look at the stock price is actually going down instead of going up. But when you invest in stocks like Eli Lilly, Microsoft, Apple, it has a lower yield. Microsoft, for example, Microsoft has a lower yield, less than 1%. But the past 15 years, it has increased its dividend by 10%. And then also, the stock price of Microsoft has increased by minimum 20%. If you do the research, it's been like 30%, but I don't want you to fact check me. Hey, Kadiro, it's 30%. Just let's not be facetious. Last 15 years, whatever, Microsoft stock price has been increased minimum 20%, has increased its dividend 10%. So imagine investing to Microsoft 10 years ago. You'd be sitting on a lot of wealth. So don't just only make, when you look at Microsoft and it's paying less than 2%, don't just only make dividends a only priority. And that hits on also just, I'm just going to buy this stock because it pays 20%, 15%, 10% dividend, and that's it. But then you look at the stock price in the last 5 years, the stock price has gone down. So keep that in mind. And then lastly, dividend commandment number 10 is thou should be mindful of special dividends. And right here, special dividends is a great example, comes from Microsoft, which issued a large special dividend in 2004. Costco tend to give out special dividends like every 3 or 4 years. OBDC, Owl Rock Capital, tend to give out special dividends. ARCC, Aries Capital, tend to give out special dividends. So every company don't do special dividends, but some companies do, and you would be astonished and amazed and happy when Main Capital, which is I think it's a BDC. Main Capital, Main Street Capital pays out a special dividend, and Main Street Capital pays out a monthly dividend. So overall, hopefully you guys learned something in regards to these 10 dividend investing commandments. Hopefully I was wanting to illustrate just low yields, high yields, how to do research, different websites like Seeking Alpha, how to do research, what to look for, payout ratios, etc., etc. High yields are fine, low yields are great. It's great to have equally in your portfolio because we are all running different races, but the goal for everyone is still the same. It's to make money and to be financially secure for ourselves and for our families. So hopefully you guys learned some. The 10 commandments of dividend investing. Hopefully you guys learned something. I brought that fire, and hopefully you learned something. And yeah, hope you guys have a great day. Peace.